Hello everyone, in this video we are going to talk about bonds, some fundamental and basic concepts, which Ali wants to start, I guess.
Exactly. So what are bonds? First of all, bond is a loan made by an investor to a borrower. That borrower can be a company or a governmental institute. And that investor is usually you who are buying the bond. So, for example, you can go get a bond from Tesla. Tesla wants to do something and they want to give a loan and get money. So Sarah purchases like $1,000 Tesla bonds and she lends Tesla $1,000 to finance whatever they want to do.
Right, then we do have credit rating, an assessment of a bond issuer's ability to repay the debt. As an example, for example, Sarah checks that Tesla's bonds are rated BBB by Standard & Poor's, which that is actually the investment grade with some risk. And in other hand, like there are ratings marked as AAA, AA, and A, and so on and so forth. So if you go down the list, there are going to be more risks with the bond. So
the middle one is BB. So
yes, exactly. So the best bond with the lower risk would be AAA.
Mm-hmm.
And the worst one would be D at the end of the list.
So then, like how you get your credit from bank and there is an interest rate or something like that, you're borrowing money, you're lending money to a company or government. So there is a interest rate for that bond. It's called coupon rate. So coupon rate is annual interest rate paid on the bond, and it's based on percentage of bonds par value. We'll get to par value quickly, but for now, assume it's the amount of money you're like essentially lending. So this is, let's say on the example we had, Sarah's Tesla bond has a 5% coupon rate. So we saw here she had $1,000 Tesla bond. So it's gonna be $50 per year for that $1,000 bond.
That is right. And then we have par value, which is a little bit challenging to understand. But let's start with an example. So the par value, or actually the face value, there are these terms can be used interchangeably. Sarah's Tesla bond has 1,000 par value, which Tesla promises to repay at maturity. We don't know what is maturity yet. We will see in upcoming sections. But for now, we know that the par value is something that you need to consider when you buying the bond. And we're going to see it in upcoming sections as well. What does par value mean exactly? So let's jump into example 2. With a $1,000 par value and 5% coupon rate, Sarah receives $50 interest annually from Tesla. This is not the yearly interest, I guess.
Yeah, this is
because
annual.
we are calculating 5% coupon rate. Mm-hmm. But we will see in the next couple of sections what these means exactly.
Mm-hmm. Mm-hmm. And most Canadian bonds have a par value of $1,000.
Yeah, that's something standard, I guess. But let's jump into maturity date and see what is that.
So maturity date is when the bond or the money you lend the Tesla, Tesla is gonna repay it in full. So if Sarah's 5-year Tesla bond, the maturity date is 5 years, she bought it in 2023, it's gonna mature in 2028. So she will get all of her $1,000 for like the par value that we saw here by end of 2028. So
So
this,
basically, that's the date you will get back your money, and that is based on the par value, right?
yes.
So next term is bond yield, which is the return on investment. So, for example, since Sarah purchased her 5% Tesla bond at $900, which is below par value, her current yield is 5.56%, which is $50 divided by 900. And then we do have yield to maturity, which is the total return anticipated if a bond is held until maturity. For example, Sarah's Tesla bond purchased at 900 with 1,000 par value and 5% coupon has a yield to maturity of approximately 7%, accounting for both interest payments and the 100 principal gain at maturity. If you want to add more, Ali, to this,
So
feel free
basically,
to jump in.
let's look at the market price. Probably that will clarify a bit. So we saw this par value. Par value is fixed. It's $1,000. It's either $10,000 or $1,000. But that is not the money you pay. That is the money you will get back. The money you pay is called market price. It's the actual price you pay. Like the stocks, they might be lower, higher, something like that. So you can go and while buying a bond, you see it is above 1,000. You see, like it's 1,050. So sorry, it's lower than 1,000. Right? No, this is above. It's
So this is
1,000.
the premium. This is above 1,000.
Above
Next,
1,000.
we have discount, which is below $1,000.
Yeah. So essentially, for when it's a discount, what you are paying is, for example, $900. But at the maturity date, when like it ends, you will receive $1,000, which is more. So in addition to interest rate, the yield, the bond yield, or the coupon rate that is like added to that, the interest, you are getting more because you bought the bond at lower price than par. If you bought higher than that, basically your yield, which is this one, is gonna be lower. You are still getting the coupon rate, the annual interest rates, but you invested like $1,050, but at the end you got 1,000.
Yeah, basically you like your investment grow more than what you expected. As you can see in the example that Sarah, if you can scroll up a little bit, like she purchased like at 900, and then the actual price was, let's say, if it was at a premium rate, it was about 1,000. So basically, she got more money from her investment, right?
Exactly.
Yeah, it's a bit complicated here, but I guess we don't need to go that much in detail. Just if we know all these basics, what those terms mean, and like at least you hear those terms. That would be enough at this stage.
Mm-hmm.
And maybe in future we are gonna deal with this more.
Yeah, absolutely. So, okay, now we want to look at the types of bonds by issuer. So, some bonds are treasury bonds or bills or notes, they're called. They're bonds which the government, the federal or provincial government or the state government in the US has issued. So, for example, like the Treasury will issue some bonds from government, and basically they're more safe. They're the government's, you're lending money to the government. So like for Sarah, for safety, Sarah wants to diversify the Tesla bond she had with a 10-year treasury bond. It's gonna pay 4% an annual rate. It's gonna be a little bit lower annual rate, but it's more safe, less risk.
Yeah. Then we do have municipal bonds, which are the same, but with local governments, within cities and within states. Um, let's say Sarah buys California bonds that fund electric vehicle charging infrastructure in the state where Tesla is headquartered. So um, this is somehow related to the first one, but in the lower scale. Then we do have corporate bond, which is issued by the companies. Um, for example, uh, besides Tesla bond, Sarah also owns Apple bonds that help finance Apple's supply chain improvement. So basically, Apple do sell bonds, and then you can invest your money in those bonds as well.
And the Tesla bond itself is a corporate bond. So the difference between the stocks of that company and the bond of that company is that when you get a Tesla stock or a Apple stock share, you are owning part of that company. But right with the bond, you are lending money to that company to do a project. It's not like
That's
the whole
right.
company.
Mm-hmm.
And like you don't own anything. It's just you're lending money, they're gonna give it.
Yeah, and then you're getting some interest.
Yeah. So
Okay.
types of bonds by credit quality, we saw by issuer, but then by credit quality. So we saw the this thing here. Credit rating, assessment of bond issuer's ability to repay debt. So based on where they sit on these ratings, we can look at two types of the bonds. One is investment grade bond. So these are high quality bonds because they have lower risk. Usually they are bonds that are rated BBB minus or higher. So like Apple bonds are rated AA and pay like 3.5% annually, like for example. So this is kind of an investment grade. On the other hand, we have the junk bond, which like usually has higher yield, but also higher risk, because these are the bonds which their rating assessment is below BBB. So for example, like let's say she buys from a small company, competitor from Tesla, and they pay 8%, but they are BB. So what is the issue if you get this? Like, what is the risk? Right?
So in terms of risk measurements, there is a term called duration, which is the measure of a bond's sensitivity to interest rate changes. For example, Sarah's Tesla bond has a duration of 4.2 years, meaning it will lose approximately 4.2% of its value if interest rates rise 1%. On the other hand, we like if the interest rate decreases by 1%, then the market interest rate will be decreased from 4% to 1%.
This is in market interest rates, right? The interest rates that the either the government of Canada, the Bank of Canada introduces, or like similar bonds. What is their current price?
Yeah. So yeah, as I said, like in scenario one, there is an interest rate increase, and in scenario two, there is an interest rate decrease. So if you go into the calculation and such, you will see that the new bond price in the first scenario is lower than the new bond price of the second. So why duration matters, Ali?
So there are three things. One is the interest rate risk assessment that we saw here. So based on that, if you want to, like if Sarah expects interest rates to rise significantly, she might choose bonds with shorter duration to maximize price declines. But if she expects rates to fall, longer duration bonds would provide greater price appreciation. The second thing is investment time frame matching. So if Sarah plans to hold the bond until maturity, until it finishes, temporary price changes due to interest rate fluctuations don't matter much. But if she wants to sell it before maturity, the duration helps her understand like what is the potential price volatility is fluctuation. And it also helps Sarah to construct her portfolio. She can create a laddered bond portfolio with different durations to balance risk. Like an example is like she gets a bond with 2-year duration, a 4-year duration, and a 7-year duration to kind of alleviate this risk.
So that was it about bonds. I think in the next week, we are going to talk about funds, mutual funds, ETFs, and such and forth. So until then, I think take care and see you in the next one.
See you. Bye.